In this video, we're going to set out how to set up a strap option trade. And basically, we will expand here from the straddle combination. So a strap strategy consists of a long position and 2 calls and 1 put with same exercise price and same expiration date. Okay, so set this out, we go back to the straddle combination we set out before, and I'll leave a link to that in the video clip below. And it is the straddle combination that we're going to copy. Now, we use this approach rather than copy and paste. Using this approach allows us to take all the numbers and the estimations when we set out the straddle strategy, and then it's linked into, again, the chart. So the chart here is consistent with the numbers we've copied over. Okay, so again, just so that we're clear, this is a strap strategy. It's made up of a long position in 2 calls and 1 put with both sharing the same exercise price or strike price and sharing the same expiration date. We will use Black Scholes to estimate the premium. It's important that when we set out these diagrams, we include in the premium, and we're using Black Scholes, which we have here also in VBA code. So that's also you'll find in the link below to the straddle strategy. So I'll leave a hyperlink in the video below the video. Okay, so very simply, all the strap strategy incorporates is that it is basically 2 call options. So 2 call options as opposed to a single call option. And from running the estimation here, it's this very simply just involves us saying, okay, 2 times the payoff on the call, including the premium position. Okay, so we'll run that and then we'll drag down. And what we observe here, different to the strip, is with the strip strategy, which was 2 puts, there was more upside as the underlying asset price fell. With the strap strategy, we've 2 call options, so that tweaks the payoff, or it tips the payoff more in the favor of the stock price going up. And we can see here that as the asset price increases, right, the value of the payoff here is high. So the benefit of a strap trading strategy is we find that we have more upside than downside. We gain as the asset price goes up and down, but there's more upside than downside. With the strip strategy, there's more upside in terms of when the asset price is falling. Now, we do have to take into account that the asset is bounded by 0, so you can't fall below 0, whereas as the stock price or asset price increases, it's unbounded, right? So that is an asymmetry between both. But the key thing to note is that as we increase the value, or as the stock price or the asset price increases, the payoff is much higher than when the asset price falls. Also, when we look at the combination here of the 2, so that's just the summation of the 2 calls and puts, the payoffs combined together, we break through much more quickly. So the break-even point is here roughly of the order of 100 and less than 120, I think, 120, whereas down here we have to drop down to maybe 70 or so, or a little bit below 70 before we're getting a break even. Okay, so that's something that we also would take into account with this strap strategy.